Good morning. Why SBA deals can fail in underwriting and how to avoid that and get yours approved. And most SBA loans don't fail because of the business. They fail because of how the deal is structured and presented. And if you're a business owner, an investor, or real estate borrower trying to secure SBA financing, understanding the difference in underwriting is the difference between closing and getting declined. So in medallion funds, we see it every day. Strong deals that fall apart, not because they're bad, but because they've been built out and presented incorrectly. So let's break down exactly why SBA deals can fail in underwriting and how to position yours to win. So let's talk about the SBA underwriting reality. And SBA lenders don't think like conventional banks. They have a different methodology and they're focused on three core pillars. So first is cash flow, is your primary risk mitigation, and borrower strength is the third category. And if your deal doesn't clearly check these underwriting boxes, it could stall or worse, get declined. So let's look at some top reasons SBA deals fail. One is insufficient cash flow, so debt coverage issues. And that's the number one killer of SBA deals is cash flow. And lenders typically want to see a DCR of 1.25 or better. And if your business or property can't comfortably cover the debt payments, the deal's going to die. So common mistakes here could be estimating revenue, but underestimating expenses or ignoring your debt obligations. And the fix there is to normalize your financials, put projected financials for 2 years together, and add back legitimate expenses, and then stress test your projections. Two is weak or inconsistent financials. And SBA underwriting is documentation heavy. So some red flags that we may notice is potential declining revenue trends or inconsistent tax returns or large unexplained bank deposits. And underwriters think, well, if the stories doesn't match the numbers, it's going to be a no. But the fix there is make sure your financials have been cleaned financially and presented properly. Make sure your P&Ls and your bank's balance sheets align with your tax returns and bank statements. And be prepared to explain anomalies. Three is poor deal structure. And this is where most borrowers lose. For example, it could be too much leverage or not enough equity injection, or it could be an improper loan type. So maybe you need a 7A instead of a 504. And the reality is structure is going to beat your rate every time. So the fix here, work with a broker like me who understands SBA structuring and helps you choose the right product for your use case. And that way we can align your terms with your exit strategy. The fourth reason would be lack of borrower liquidity and reserves. And even if the deal works on paper, lenders want to know, can this borrower survive a downturn? And financial reserves is how they compensate in that category. So you don't have to be perfect, but we need to make sure we check a few boxes. And we need to have post-closing liquidity. We want to have larger reserves or less personal leverage. And the fix is really maintaining your liquidity after closing and avoid draining all your capital into the deal and finance as much as you can, which shows financial strength outside of your business. Five is industry risks and experience gaps. So SBA lenders will evaluate each industry and its volatility, but also that client's experience in that industry. For example, a first-time restaurant owner is a higher risk, whereas an experienced operator is a stronger profile. So the fix there could be partner with an experienced operator, highlight your transferable skills, provide a strong business plan, or buy a franchise. They have the program set up for you. Six is incomplete or disorganized documentation. And this is the silent killer. If you're missing tax returns or personal financial statements or business plans, the delays in getting that paperwork cause doubt with a lender and could end up in a decline. So the fix there is you submit completely documented and organized packages up front. And that way we can anticipate lender requests ahead of time and move fast and stay responsive, not reactive. So the real insight, SBA is a story plus a structure game. And underwriting is not all about numbers. But if we have a good narrative backed by data and strong sponsorship, things can make sense. So strong deals clearly answer these questions. How does this loan get repaid? What happens if things go wrong? And why is this borrower the right operator for this job? So, how to get your SBA deal approved? Well, talk to Bill Rapp at Medallion Funds, and we can position your deal to win by focusing on your proper deal structuring. We match you with the correct lenders. With 600 plus options, we've got choices. And we present clean financial presentations. We have risk mitigation strategies in place, and we deliver a clear borrower story. So the final thought for the day is that most SBA denials are preventable. And if you're applying for, say, a 7A loan, a 504 loan, or business acquisition, or just for owner-occupied real estate in general, strategy matters more than you think. And work with a broker who understands underwriting, not just the application process. And that, my friends, is it for the day. Love to talk to you more about your situation, how we can make you shine. My number here, well, visit my website. You can get my contact info from there. Go to billrapponline.com. That is it for the day. Have a good one.